This is InvestTalk. Independent thinking, shared success.
I was calling to get your thoughts on Bank of Hawaii, ticker BOH. I know it's come down quite a bit. I was just seeing what your thoughts were to get in now and kind of go from there. Looking forward to hearing your thoughts. Thanks. Bye.
All right. Looking at Bank of Hawaii. It's a regional bank. I probably don't need to explain where they operate. And this is a name that came down from a high of around $82, $83 per share. That was back in November. Now we're down to $63 per share. So quite the pullback. I want to look at this compared to the banking index. Is it outperforming? Is it underperforming? It's actually been outperforming. That's a positive here. However, the issue is that this is going to be highly correlated with the economy of the Hawaiian Islands. And in a recession, do people travel less? Absolutely. Absolutely. And then if you think of the lack of travel from places like Canada and Europe to US states, which Hawaii is one of them, that is likely to put pressure on traffic as well. So generally, I would like it, but not in this environment, okay? Because of that likely dip in travel demand that's already started. I also take a live call. Sid in North Carolina looking at SMCI.
Thank you, Justin, for taking my call. Really appreciate all the knowledge and the information. I don't have this in my portfolio, but I just have it in my radar in case it has a volatility and not sure this is a good company in the first place. And if it is a good company, then what's your inputs for the entry point? Thank you so much for your inputs.
No problem. Thanks for the call. Looking at Super Microcomputer, a name that had a big boom in 2022 through early last year. I guess it would be late 2023. And it peaked a little over $100 per share. Now it's at $33 per share. So down 70-80% from its high. Overall, that's a good thing. It's a lot of the excess has been wrung out. But the problem is that they had some accounting issues. I am usually wary of companies that have accounting issues. It tells you a lot about the seriousness of their business practices. And so I would be wary of that. Plus, what they do is they make servers for AI data centers. And the AI narrative was weak going into these tariffs, and now I think it's even weaker because it's going to be much more expensive to build out these capabilities because there are going to be tariffs on semiconductors, just kind of waiting to see what that is. So yeah, not a name that I would have on my radar right now. Explore additional content and tools by heading over to InvestTalk.com.
My question today is in regards to why do some foreign companies offer two stock listings on the exchange? It is a common theme I started to notice as I continued to do my research. An example being is Schneider Electric. Their two stock symbols are SBGSF and SBGSY. As I continue to do my research, is there one better than the other? I noticed that one stock symbol is significantly higher than the other. Just trying to figure out what would be the better investment in the long run. Thank you and look forward to hear the answer on the show. Bye.
Well, this answer is fairly simple. It's just different listings. So the company can be listed on different exchanges. So you listed a couple of you listed Schneider Electric, and they do have a U.S. listed ADR, and then they actually have one that's on the OTC pink sheets. It's really about liquidity. Which one trades more? Which one can you get in and out of with the lowest spread? That's typically how it works. Now, there are ones that have different share classes and voting rights, and they can trade at different premiums based on that. Google is a good example. But if you're talking about these names that have these 5 ticker symbols that are, some are listed on the OTC. That's what Schneider is listed on the OTC as well as U.S. exchange. then I would go with the one that's the most liquid, which is probably the one that is on the US exchange, and that would be SBGSF. Hope that helped. Now let's try another question from our comment section over on our YouTube channel. And Iraq Dawn says, long-time listener, I think I have a stock you guys will like, but most likely too expensive now and would like an entry point. P is 30.5, and recent tariff corrections really haven't touched it. CASY General Store, CASY, looks to be a phenomenal performer, but I'm now just hearing about it. They don't seem to be overly saturated with stores in the US yet. I live overseas and I've never to visit a store. Their stock price seems to go nowhere but up. Your thoughts? All right, looking at CASY, and you're correct. This is a name that has not been bothered much by these tariff talks. And it is now at a 52-week high. It had a little gyration during the day after Liberation Day, but every down day was met with another up day. So, the reason is the nation's third largest convenience store chain, and typically these businesses are very consistent and very profitable. Now you're right; it is on the expensive side. Its enterprise value is $19 billion. And it's free cash flow about $500 million. So talking about a 4% free cash flow yield, not amazing, but it's fine. Now, the worry here is the market underestimating the impact of tariffs on the broader economy, as well as the cost of the goods that they're buying, right? You're talking about, usually these are gas stations people pop in, they buy a few snacks, maybe some drinks, etc., beef jerky, all of that. And it's a very, very profitable business. However, if there's people out of their job, are they visiting the gas station less? Are they walking in and splurging and spending $20-$30 on stuff in their convenience store? I think that is certainly a worry. So it's absolutely a name that should be on your watch list, but just probably not in this economic backdrop. So I think the market is underappreciating the risks to CASY's, but a pullback sub, say $300 per share, and that's a 464. That would be an area that I would like to pick up CASY's. Thanks for the call. Now let's touch a little bit on the end game here. The end game when it comes to tariffs. And there are some people that are optimistic that there will be quick deals cut by President Trump, and the reciprocal tariffs, we'll call them in quotes reciprocal because obviously they weren't, but that they are eliminated and they're rolled back to something that's very minor versus the base case right now, which is, we're at 10%. They're negotiating. These tariff deals take a while, and odds are good that this is going to be drawn out. And as it's drawn out, with that uncertainty comes a lot of economic pain. I always talk about this formula: C plus I plus G plus X. C is consumer. 2/3 of people, and that's the formula for GDP. C is consumer. Consumers who think they're going to lose their job, which 2/3 of Americans think they are at risk of losing their job, they're going to spend less, bottom line. So that's a hit to C. I is investment by corporations in plant, property, equipment. They also are now spending less because they don't know how to navigate this market. Are you going to commit millions, if not billions of dollars to a project that has an uncertain cost and timeline? Probably not. Then there's G, which is the government spending. Obviously, Doge trying to cut spending. Elon looks like he's pulled back his goal of $1 billion. It was $2 trillion in cuts, then it went to $1 trillion. Now it's $150 billion, but even that is still not really confirmed. Now, overall, it's a positive, at least near term, right? You can argue whether he needs to cut more, and there's more efficiency to be wringed out of the the government. But at least in the short term, that's kind of static, right? We're still at the record deficit compared to previous years. So his efforts haven't really changed the fiscal trajectory of the United States Treasury. Now, as constituted, tariff rate is at about 24%. 24%. That's higher. That's the highest in the world currently. Much higher than the other highest was Iran and Venezuela, 12 and 14%. So we're double Iran. Think about that. Now it could go up if there's more escalation of trade tariffs, if there's the promised tariffs on pharmaceuticals and semiconductors and other sectors happen as well. And we don't come to major trade deals that lower those tariffs significantly. So there's still that, in our parlance, we talk about right tail and left tail. You have the base case, what likely is to happen, but right tail is things could go really well, much better than expected, or left tail, things could go much worse than expected. So obviously, if things escalate, then that would be a left tail event. A very left tail event would be not just escalating from an economic standpoint in tariffs, but an actual war, a hot war between, say, us and China. That is, think of the next order effects. Obviously, you have two sides, two of the biggest superpowers trying to battle it out economically. And there's always that risk that there's something that happens that triggers one to overreact. So there's that potentiality as well. Then there's the other side, which is, hey, we get enough pushback from the government. Sorry, not the government, from Wall Street, from just individuals. You get enough bad data from the economy, and they pull back, and the Fed comes in and helps liquefy markets again, and lowers rates and stops QT, maybe does QE, and tariff rates go down to low single digits, and it's a minor nuisance as opposed to a major problem that it is today. That's the right tail risk. Our base case, though, is it drags out. And even if we pull back to some degree and we bring tariffs on China back down to a reasonable level, whatever reasonable is, even if we have tariffs in the mid-teens, that's still very bad for the global economy. And will have bad consequences. We would face higher prices domestically. Lower quality employees would be shifted into less efficient jobs than the service economy that most people work in, or some sort of higher productivity business. Because think about the damage to companies, U.S. companies that export to China, for example, and other countries that have slapped on reciprocal tariffs. Those people might get laid off, and now they have to do jobs that are less efficient for our economy. So overall, the base case and the left tail is lower investment, lower growth. Now, for context here, over the last 50 years, tariffs have not moved more than 1 or 2 basis points. Sorry, 10th or basis points or 2. So you're talking about 0.1, 0.2%. Very minor. And now you're talking about massive increases. So what is the off-ramp here? It's maybe someone talking sense. It seems like that was part of the pause. Jamie Dimon coming in saying this is creating major disruptions in markets, dollars selling off, treasury yields blowing out, and he paused. Now, that was with a lot of volatility. Bear markets typically get kind of slow trickle lower. And I think in that case, he's not going to do much. He's not going to feel it. He's not going to feel panic. Right? He came out and said, oh, I did it because people were getting yippy, whatever that means. Well, a bear market no one's really getting yippee. They're just, bleeding out. So the real way out is Congress, right? Taking back power and not leaving up to just one person, right? And so that's kind of how we're thinking about these tariffs and the likely path forward. And hope that gave you some context of how to think about both the base case as well as right tail and left tail outcomes. Now, this is InvestTalk, now with more than 61 million downloads, all thanks to you. So let's keep things moving and play another listener question from 888-99-CHART.
I'm calling about ticker symbol TAP, TAP. That's Molson Coors. I wanted to see if you thought this nice upward trend it's been having is going to is it going to stall out, you think? Or do you think is it a good time to get in? Or should I wait for a pullback? Thanks.
All right, looking at Molson Coors, you bet correctly. It's Coors Light. And this has been in a very choppy range between a high of $70 and a low of $50 over the past couple of years. Now we're pretty much smack dab in the middle at $59.50 at the close today. 3% dividend yield. But the question is, are people going to buy more beer in a recession? Now, historically, it has been a good recession bellwether. People buy beer, whether the economy is good or bad, right? They especially those that drink regularly, they still have their six pack on a regular basis or whatever they drink. And so it tends to be a consumer staple type of stock. However, there are some longer term trends, especially for younger individuals who are just drinking less. Okay. And they're also shifting to hard seltzers, which I'm not sure what their seltzer is, but I don't think it's the biggest one. And so that's my worry here is the longer term secular trends of less people drinking. This company does have a good amount of debt, about $6 billion in long-term debt. And its free cash flow yield compared to enterprise values around 6%. So not bad. But I just don't get excited about it. I do like the financial performance overall, but the profitability at 8% return equity, middling. So I think there's better opportunities, and I don't love the secular trends of far less people, especially younger people, drinking.
Thanks for joining us.
If you found this helpful, please hit the like button and subscribe for more future videos. Now, real quick, let's fit in another listener question from our InvestTalk YouTube channel. Luke Olker says, hello, I'm curious about your thoughts on Alibaba Group stock and its long-term growth. It seems like there's a lot of risk because of Chinese regulations and their relationship with the US, but also seems like there's a lot of upside because there's e-commerce business and expansion into AI. Thanks, enjoy your podcast and listen almost every day. So the issue here, you're right. There's a lot of geopolitical risk. Alibaba, it's a Chinese company, and it was hurt by these recent tariffs. Remember, their main platform is for companies or individuals in the United States to go on their platform and source cheap Chinese goods. Obviously, that's not going to be good for their business. Then you have what I said earlier is that left tail risk of, more contentious geopolitical problems with China. And I see that as every day goes on, that becomes more and more likely. I'd say it's likely. I'm just saying more likely. So I don't see a good risk versus reward here. If you want exposure to the Chinese economy, I would want exposure to names that aren't exposed to exports, right? In some way, shape, or form. So I don't see a good risk versus reward on Alibaba. Although I will say the chart is in an uptrend and it is at support. So from a technical perspective, I would say I'm relatively bullish shorter term, although that can explode any minute, as you see with the overall market. So I did find support, but I wouldn't trust the support to really hold. Now, lastly, let's touch a bit on when does this sell-off actually impact the overall economy? Now, sometimes it doesn't in a material way. You had the Asian financial crisis in 1998 and it didn't really impact the economy. But over the years, more and more wealth is being concentrated in equities. As going into this year, you had a higher percentage of wealth in stocks than we've ever had in the United States. Think about that. That's what set up this sell-off. And 58% of American families hold stocks directly. And those in the top 10% have about $600,000 plus. So the percentage of household assets in equities was at 36% to start this year. Highest level on record. I just want to reiterate that. And post-pandemic, you have a lot of new investors thinking about their investments and following their investments on their smartphone regularly. And that's kind of become a thing. Now, 2021 paper shows that for every dollar increase in the stock market, consumers spend 3.2 cents a year for every dollar. So it works in reverse as well. And then for companies, when markets become unmoored, one way to put it, the impacts on the economy can be wide-ranging. Number one is raising money, whether that's through equity or debt. They will hire less if they cannot raise capital that is needed. And 2 Fridays ago, you saw IPOs being pulled. You saw investment grade companies not able to issue bonds. That's when the S&P was down 6%. Worst week since 2020. So that's what happens when you get these markets becoming dysfunctional. And it can have a very material, immediate impact on the economy, especially in this economy, like I said, where 36% of assets for individuals in this country were held in equities. That's a record high. So in many ways, now the market isn't front running the economy. It's now the tail that is wagging the dog. I'm Justin Klein. This completes another InvestTalk program. We thank you for tuning in and telling your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And keep in mind that we can help you better understand your risk and rewards in this market and help you navigate these uncertain times by completing a portfolio review and really charting out your full financial life. So head over to investtalk.com, click on the portfolio review button. And if you haven't optimized your 401k, we can help you there as well. We've saved a lot of people by elevating their cash levels going into this year. Independent thinking, shared success. This is InvestTalk. Good night.